All right, so you've heard of this supposedly 1% rule in real estate, right? The one that all the gurus talk about for finding cash flowing properties. Well, today we're going to break it down. And more importantly, we're going to talk about what it really means and when it actually works. Think of the following not so much as a firm answer, but more as your initial rapid filter to sift through hundreds of potential deals. It's a litmus test to see if a property is even worth a second look. So at its very simplest level, the 1% rule is all about triage. You know, like in an emergency room. Doctors quickly sort out who has to be seen immediately and who can wait. This rule does the same thing for your investing pipeline. It has but one purpose, to help answer one very simple question. Will the monthly rent this property can garner be sufficient to at least cover the mortgage payment? If the answer is no, you can probably move on and save your time and energy for the deals that are more likely to work. It's not a matter of working to make a property profitable yet. It's a matter of eliminating the ones that are almost certainly not. Okay, let's get into the math, because it's actually very simple, but there's one key detail you cannot miss. Here is the formula. Your gross monthly rent needs to be equal to or greater than 1% of your acquisition price. Now, pay attention to this aspect. Your acquisition price isn't always the purchase price. You have to include the cost of any immediate necessary repairs that are required to get the property up to rentable condition. So, if you buy a house for $100,000, but it needs a new roof that will cost $15,000, your total cost basis is $115,000. That means you need to ensure you can get at least $1,150 a month in rent. This forces you to be realistic from the start and penalizes properties that need a ton of upfront capital. So what does this look like in practice? Let's run through some examples. On an $85,000 single-family home, the 1% rule would have you aiming for $850 a month in rent. Simple enough. On a more middle-of-the-road investment, such as a $150,000 duplex, you're at $1,500 a month. And this even holds true on giant commercial deals. A $10 million apartment complex? Yeah, that's got to generate $100,000 a month in rental revenue. The rule is easy and adaptable, which is how it's endured all these years. But here's the thing. The 1% rule became popular way back 30 or 40 years ago, during a completely different real estate market. The prices of homes were much less than what people could rent them for. Hitting that 1% target was a much more common occurrence. These days, especially in hip cities, real estate prices have gone through the roof, but rents haven't necessarily kept pace at the same level. So, in most sought-after neighborhoods, this rule starts to sound like a legend. And the gap says a lot about the market we're looking at. So why is it so difficult to find a property that satisfies the 1% rule today? Several major reasons. First, property prices have increased much more quickly than rents in most locations. Second, expenses have shot through the roof. Consider property insurance, upkeep, and labor. Add to this property taxes and zoning regulations that restrict new building, which maintains low supply and high prices. And finally, with increased interest rates comes the reality that your mortgage payment is higher. So you require an even broader spread between your rent and your costs. It's a perfect storm that renders the 1% rule a difficult one to break. Now, just because a market fails the 1% rule doesn't automatically render it a poor investment. It merely means you're playing a different game. Markets that do achieve the 1% barrier are generally what we call cash flow markets. These are usually smaller, secondary cities where high monthly return is the focus, but the long-term appreciation can be slower. On the other hand, markets that penetrate only like 0.5% to 0.7%, places like San Francisco, New York, Boston, are appreciation markets. You're not investing for cash flow now. You're hoping for the value of the property to skyrocket in the long term. It's the classic trade-off between near-term cash flow and long-term total return. And this is where we come to the biggest problem with the 1% rule. Its worst failing is its simplicity. Because this rule only looks at gross rent, it leaves a gigantic blind spot. It doesn't cover all the hidden costs that actually determine whether you make or lose money each month. Applying this rule alone is like going on a road trip and only budgeting for gas, but not for food, hotels, and tolls. You're going to blow through money in a hurry. Let's name and shame these excluded expenses, as they are deadly. The 1% rule doesn't factor in property taxes and insurance, which are huge and inevitable. It doesn't factor in maintenance and having to budget for those big future repairs like a new HVAC system. It assumes your property will never have a vacancy, which is unrealistic. And it does not factor in property management fees or utilities that you might have to pay. So a property can pass the 1% test on paper, technically, but then bleed you every month once you factor in all these real-life expenses. This establishes what I call the profitability illusion. The rule causes unwary novice investors to think, hey, the rent is 1% of the price. I'm good. But actual profitability is what's left after you pay all your expenses and the mortgage. A rule of thumb is that operating expenses alone can eat up 50% of your gross rent. So if half of your income is gone before you even get to pay the mortgage payment, that profitable property can quickly turn into a money pit that has you pouring money into it constantly. Scary, isn't it? So just to be clear, here's what the 1% rule does cover and what it noteworthy excludes. It does cover your purchase price and those first repairs we spoke about. But it specifically excludes property taxes, insurance, maintenance, and vacancy costs. And while it tacitly attempts to cover your debt service, it doesn't actually calculate it. That's why you must immediately merge it with still another tool in order to get to those excluded costs. And your life partner is the 50% rule. This is the yin to the yang of the 1% rule. The 50% rule estimates that roughly half of your gross rental income will be consumed by operating expenses. Again, that's taxes, insurance, maintenance, vacancies, everything except the mortgage. So if your property makes $2,000 a month, you can figure about $1,000 will have been lost to expenses, leaving you with $1,000 to apply towards your mortgage payment. This is the money that actually makes it to your bank account. Combining these two rules is how you go from a naive screen to a smart first test. So here's your new powerful 1-2-3 punch. Step 1. Apply the 1% rule. Is rent at or above 1% of your all-in cost? If yes, proceed. Step 2. Apply the 50% rule immediately. That gross rent, cut it in half. That's your net operating income, approx. Step 3. Match that number to your approx monthly mortgage payment. If your mortgage payment is more than what's left, the deal is numerically flawed, and you have to walk away. This simple rule will save you from investing in an infinite number of bad deals. You might have heard of other rules, like the 2% rule, which is exactly what it sounds like. It calls for twice the rent. On a $150,000 home, you'd need $3,000 per month. This is super aggressive and gets you properties with a huge safety net, but it's very hard to come by. Another measure is the gross rent multiplier, or GRM, which is the purchase price divided by the gross annual rent. It tells you how many years of gross income it would take to pay back the property. A property that meets the 1% rule has a GRM of approximately 8.3. You can utilize GRM to directly compare properties within the same neighborhood. When you get more serious, you will move into the professional metrics. It is almost like a hierarchy. The 1% rule is the bottom rung, the quick and dirty filter. Next, you have the cap rate, which measures the property's value by its net income, independent of your loan. This is to compare the property itself to others in the market. Then there is cash-on-cash return. which is king with most investors because it tells you the return on the actual cash that you put into the deal after you've paid the mortgage. And the most sophisticated is the internal rate of return, or IRR, which considers the time value of money and your profit upon sale. Let's talk about cap rate for a second. This is probably the most useful single metric for comparing properties. It's equal to net operating income divided by the property value. It's called an unleveraged yield because it tells you what your return would have been if you'd bought the place all with cash. A higher cap rate typically means higher risk, but perhaps higher return. It's the fundamental measure of the inherent quality of the property, regardless of how you choose to finance it. But most of us borrow, don't we? That's where cash-on-cash return comes in. This is your personal scorecard. It's your annual cash flow. So that's your NOI minus your mortgage payments, divided by how much cash you had to put down out of pocket, like your down payment and closing costs. This figure is significant because an average cap rate property can still have an amazing cash-on-cash return if you have a great loan. It's a testament to the power of leverage. Now, passing the 1% and 50% rule tests doesn't mean you immediately go out and purchase the property. It just means you've passed the test to invest time and money in serious due diligence. This is where you dive deep and confirm everything. You're going to scrutinize the seller's financials, get a pro to inspect, make sure the title is clean, and see if it's up to code. Due diligence is how you find out about the skeletons in the closet before they become your problem. So where does that leave us? The 1% rule is still an incredibly valuable tool, but you have to implement it strategically. It's perfect for investors who are considering monthly cash flow, pointing you to markets where rents and prices still have a relationship to each other. But in those highly appreciating high-price cities where the 1% rule can't work, you must compromise. You might lower your standards to 0.7% or 0.5%, understanding that you're investing for long-term appreciation, not for current cash flow. So here's your action plan. Step 1. Use the 1% rule as your gross screen to rule out clear losers. Step 2. Apply the 50% rule to see if the mortgage is serviced by the estimated net income. Step 3. Calculate the cap rate to see how the property stacks up against the market. Step 4. Do your due diligence, the legal, physical, and financial deep dive to uncover all of the risks. And finally, Step 5. Using all that verified data, crunch your ultimate cash-on-cash return and IRR figures to make a smart, educated investing decision. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.